What if I told you that you could acquire a real estate investment property today without going to a bank, without a large down payment, and sometimes without any money of your own at all? This is not a sales line. This is creative financing. And in this video, I'm going to break down exactly how it works. Here is the belief that is costing you deals right now. You believe that real estate investing requires a significant down payment, excellent credit, and bank approval. For conventional financing, you're right. But conventional financing is one tool in a large toolbox. And for the most motivated sellers, the ones with the best deals, conventional financing is often not even available. The property is distressed. The timeline is urgent. The seller needs a solution no bank can provide. That's exactly where creative financing thrives. My name is Rick Puglisi. 19 years, 400 plus transactions. Let's talk creative financing. Creative financing is any acquisition strategy that does not rely on conventional institutional mortgage. Why does this matter? 3 reasons. Access opens doors that would otherwise be permanently closed. Speed. Creative deals close in days, not in months. Terms. When you negotiate directly with a seller, every term is flexible in ways a bank would never allow. A homeowner has an existing mortgage. They need to sell quickly. Instead of the seller paying off that mortgage, you take title to the property while the loan remains in place. The loan stays in the seller's name. You make the payments. Why would a seller agree? Their primary need is relief from the property, not maximum price. A seller facing foreclosure who needs to move in 30 days may prefer to give you the deed subject to their mortgage rather than lose it to the bank and destroy their credit for years. What do you get? An asset with all its equity, cash flow, and appreciation at the existing interest rate without qualifying for a new loan and without a conventional down payment. The risk? The mortgage contains a due on sale clause. The lender technically has the right to call the loan due when ownership transfers. In practice, lenders rarely exercise this right as long as payments are being made. Understand this risk. Work with a real estate attorney. Structure the deal correctly. Subject to requires thorough legal knowledge. Do not attempt it without proper preparation. The seller becomes your lender. You negotiate purchase price, interest rate, and payment schedule directly with the seller. No bank approval. No conventional down payment. Terms are whatever you and the seller agree on, which means they can be structured in ways a bank would never allow. Who agrees to seller financing? Sellers who own free and clear and prefer monthly income over a lump sum. Sellers who want to spread capital gains tax liability over multiple years. Sellers who cannot sell conventionally because the property has issues preventing institutional financing. Requires a promissory note and a mortgage of deed of trust, legal documents protecting both parties. Work with a real estate attorney. The legal cost is minimal relative to the deal value. Skip it and the cost could be the entire deal. Lease options. A lease option gives you the right, but not the obligation, to purchase a property at a set price within a specific time period. The structure? You negotiate a lease at market rent. As part of that lease, you negotiate an option to purchase at a set price within a defined period, often 1 to 3 years. In exchange, you pay an option fee, typically 1 to 5% of the purchase price. Compared to a 20% conventional down payment, that is a fraction of the capital required to control the same asset. During the option period, you control the property. Occupy it, rent it to a tenant at a profit, or improve it and exercise the option to buy at the locked-in price, which may now be below market if the market has appreciated. If you choose not to exercise, you walk away. You lose the option fee, but have no obligation to purchase. Capped downside. Open upside. The asymmetric structure makes lease options particularly powerful. Joint ventures. A joint venture is a partnership where you bring the knowledge, the deal, and the execution. Your partner brings the capital. You split the profit. This is creative financing because you're accessing capital without a bank, without qualifying for a loan, and without a down payment from your own resources. Debbie and I structured our first major deal as a joint venture. We brought the deal and our market knowledge. A partner brought their capital. The result? $45,000 in profit split between us. We did not have $45,000 to invest. We had knowledge and a deal. That was enough. Put everything in writing before the deal closes. How are decisions made? How are profits split? What happens if one partner wants to exit? A well-drafted agreement prevents problems before they occur. The absence of one creates problems that last for years. Creative financing is not a shortcut. It's a skill that opens deals and markets that conventional investors cannot access. The investors I have watched use these strategies most successfully all had one thing in common. They invested in understanding the legal structures and negotiation frameworks before their first deal. They prepared. They did not learn through expensive mistakes. That preparation starts with the 5-day real estate investing challenge. Click the link in the description. 5 lessons covering every strategy, included creative financing in depth. 0 cost. Fair warning, I'm an AI. The real Rick is home eating leftover pizza. You're welcome. Hit subscribe for weekly content. Drop a comment. Which creative financing strategy resonates most with your current situation? I read every comment. I'm Rick Puglisi. Now go structure a creative deal.